all the different theories and appropriate formulas and such, but I think that looking at what people in the real world are thinking about and speaking about is going to be much more relevant for us. So what I will do is for each class, pick apart from what I put together and say which pieces would be of interest and help you prepare for the next class or to support the class that you've done, and for yourself to go back. And if you have any questions about any materials before or after, whatever, just let me know. So I think that will work a lot better than just reading. There's nothing wrong with school books, but trying to be as close as possible. So we're going to just review, we're going to sort of set out, as well as I didn't do that last week, the thought process of putting this class together, how the progress, how it proceeds. And ultimately the goal is to be thinking about, you are an investor, how is it you're in the real world, you work for a pension fund, you work for an investment manager, a bank, insurance company, how is it that you would actually begin to think about investing outside of your market? How would you put together a global real estate portfolio? So that's what I want you to, I'm going to work to give you the tools to be able to make those decisions. And along the way, we're going to have certain real life, taken from my professional background, examples and exercises that you will then take those notions and ideas and theories and apply it to actually making decisions, and then you will present your decisions. So we'll first start with looking at the first assignment, which I will post after this class. It's not due yet, but I just want to get you thinking about it, is how is it that you will compare country versus country versus country versus country? So very high level we're starting at, very macro level of comparing countries, okay? Then we will move into thinking about the actual real estate itself in these different markets. And you will then start to analyze a particular country. Each group will be assigned a particular region, and you'll actually underwrite or analyze the opportunities and risks in your assigned country. And then you will also be charged with, as your colleagues, your those students will present their case studies to us, you will be saying whether or not you will be investing in those particular countries. So the whole mindset of this class is that you are an investor. And I want you to start thinking about being an investor. Because no matter what role you're going to be in, if you're going to choose to stay in real estate, these kinds of thought processes will serve you in terms of making investment decisions. Even if you're just doing something, you're in Queens and you're just doing medical office buildings in Queens, it will still help guide you. So we will then underwrite the country. We will then look at creating an actual portfolio. So you are going to come forward with your ability to think through how to compare countries, how to underwrite a particular region, and then you're going to actually put forward a recommendation for a particular portfolio, thinking about countries, thinking about asset sectors, thinking about levels of risk appetites and such, and returns. So you'll actually create a global portfolio that you'll have to defend to all of us. And then the last assignment, I think I mentioned last time, how to actually analyze, as a U.S. investor, how you're going to analyze an actual investment proposal for a development project in China, in Shanghai. Okay? So there's a very clear path of how I thought through of taking you to build the confidence and ability to invest on a global basis and whether or not it makes sense. Part of it is you always have to question, is that the right answer for you? Should you be doing a global portfolio at all? Are you better off, depending upon where is the capital coming from? So, any questions about that?
Do we have
Yes.
all portfolios
Yes.
together.
Yes, so we've
Set
been
yourself.
speaking about, and I sent out with the reading website, a link to, CalPERS, which is a California Public Employee Retirement Systems, a pension plan, right, government pension plan, which funds, as we said, most of the real estate that we think about and look at in investment. And so you look at what they have, we're going to say you have $100 million and you are from CalPERS. We all have to get familiar with CalPERS and what their requirements and who they are and what they do and what they've already done in real estate. And each assignment you'll have, I think one was like $250 million US, and we'll break it down, you'll have an exact amount of money. So I'm replicating, these are things that I did, and you're replicating real investment processes and thinking about how to do this programmatically. Okay? So we started last week to think about some very macroeconomic issues, and we're going to continue along those lines. Why do you think we're even thinking about the macroeconomic pieces of this puzzle when we're talking about real estate specifically?
In comparison with different countries?
Yes, well, and just in general, what we're thinking about what we're talking about now is how to build out a global real estate portfolio. So why would we care to think about macroeconomics when we're thinking about the real estate? A lot of people just want to okay, let's, how much are residential buildings going, what's the cap rate or whatever, as opposed to digging into the weeds like that. We're starting at a very high level.
So on a global basis, because I oversee APAC, and the problem that I have with APAC is that when we're looking to make a substantial investment to expand operations, on a macro level, we have a lot of issues related to FESTL, which is the political, economic, social, technological, legal issues. Legal issues usually are the number one because the market's volatile or there's political instability, which results in us losing all of our investment pretty quickly.
I'm sorry, introduce yourself.
I'm Jessica. I just moved here from LA, and I work for a Fortune 500 company that's heavily in manufacturing, and I oversee 400 locations throughout Asia and North America.
Okay, well, you will be very helpful for us then. Okay. So, all right, so what Jessica's saying is that as someone who's actually overseeing a portfolio, that she's thinking about some of the political and other kinds of risks that are out there that need to be considered when making certain decisions. And why would that be?
I think the larger issues generally end up trickling down to kind of a local level. So for example, if you're looking at an economy as a whole and there's, a looming recession, for an example, if you look at the local market right now, the office market might be booming, but if we're going to forecast that, there's not going to be a lot of job growth, for example, maybe that impacts the demand for a certain asset class in the future that you might be thinking about investing in.
Right, exactly. So what that sums up to is macroeconomics and politics and all those kind of large issues impact real estate. And we want to what? Be able to forecast how real estate is going to behave. Because what are we doing? We're buying something today that's based on what?
Future cash flows.
Exactly. So I don't know how good you guys are at forecasting, but we all start to get in our own way, get a gut feeling for, everyone talks about their gut feeling about something. I don't really care about that. What we want to look at here is getting as close as possible to forecasting based on numbers, based on assumptions, based on what the market is telling us. There's a lot of information out there. It's for us to dig through that information and figure out what is that information telling us to help us become better forecasters. Because the ones that are going to win, to make the best investments, are the ones who are going to be able to do best forecasting. And the best forecasting is not based on, you know, which way the wind is blowing.
I mean, I was gonna generalize saying they're like the key indicators that tell you how healthy a market is.
Mm-hmm.
Like,
Right,
very specifically.
right.
if you're looking-
But what does everyone always say? The past is not an indicator of the future, right? So we do know that. However, it's information. And what are we living in? The information age, right? So we should take that information as best we can to be able to make certain assumptions and certain forecasts. Now, we're not going to get perfect, and we're not ever going to get it 100% right, like forget that, because stuff is going to happen, as everybody says. But we can at least look at trying as best we can to look at the indicators to tell us that there's something we should be thinking about in terms of risk, and not necessarily not to do the deal, but how do we manage for that risk? There were some people who did forecast the global financial crisis. What were they looking at? What were they thinking about? Right? So the other piece of this puzzle, again, the question of why look at macro topics, is because how do you start to compare? It's all about comparison. It's all a relative game. Real estate is a relative game. You can either invest in one deal or another deal. How are you going to compare those two deals? Right? So it's the same thing with what we're looking at from a global perspective. How are we going to compare the various countries to each other? Okay? So that's the thinking behind all of this in terms of I always ask why. Why are we doing this? So you can challenge me too and ask me, why are we bothering? So that's the why. Okay. All right, who just walked in here? Let me just get my attendance list up to date.
Jared.
Jared, okay.
Anmol? Anmol?
I'm all right, okay, good, okay. Okay, so. All right, so we started to talk about last week, why are we doing this? Why are we here? Wednesday night, there's a lot of other things we could all be doing. What else could we be doing? Now, why are we investing? Why are we thinking about investing globally? What did we say? What was like the number one thing? You all knew it from before I, started spouting my stuff.
Diversify your portfolio or your investment.
Diversification, right. And what does diversification do for us?
Reduce risk.
Right, how?
Well, not having all your apples in one basket, sort of one equity, I mean, you're not counter-cyclical, but the correlation between real estate and
Exactly.
equities is not that high. I guess.
Right. So this goes back to what I just started to say. It's a comparative factor, right? And we want to manage the risk. What does modern portfolio theory tell us? It tells us that by having, as Markowitz came up with that, by having diversification, it manages the risk. We want, as a group, to get to the highest return for the lowest risk. Or, said the other way, what does the lowest risk, how do we manage for the lowest risk, and what kind of return do we expect for the lowest risk? So it's not always the highest return is the best answer. It's combined, the two of them that we have to look at. So this diversification is one thing that global or international real estate is going to do. Okay? Why else are we doing this? Maybe we don't have any other options. Remember I told you who was the first group of global investors to go out of their own country and invest in real estate outside of their own country? Thank you. Oh, you're listening. Wow, I'm impressed. I'll sit down now. Exactly. And why was that?
Their home real estate market was too small.
Exactly. Right. And who were the last ones to go overseas? Exactly. Right. Because it's such a huge market here. Right? So it's that kind of large portfolio thinking. And that's think portfolio, don't think asset, think portfolio for what we're doing. Okay, so, and Jessica, these are some of the points that you were raising, the examples of what's driving a lot of this. The economic factors, we're going to cover all of these in lots of detail. Economic factors, GDP, employment, inflation, currency, covered 3 of those today. Demographics, what's happened in terms of the shift, the urbanization into cities. I think, I don't know how many years ago now, it was probably 4 or 5 years ago, where it finally reached more than 50% of the world's population are living in cities as opposed to urban areas. That's massive in terms of indication for investment going forward, in terms of infrastructure and in terms of everything. You know, there's nothing you can, education, everything needs to be adjusted to accommodate that kind of global shift. And that's some of the things that we're going to look for, these kinds of shifts in the different major economies give us an idea in terms of where we should be positioning ourselves. Let's see, government, okay, so we saw, what did we talk about last week? Risk-free rates, right? So why do we care about the risk-free rate? What is the risk-free rate and why do we care about it?
Based on the US Treasury bond, we're basically trying to see what's, like, I'm not gonna make an investment where I'm gonna earn less than that, where I'm taking risks, so it's like, I guess that's kind of the benchmark I'm comparing it to when judging whether I'm making an appropriate return based on the risk for a certain investment.
Great. The only thing I would tweak a little is not necessarily the US, right?
I guess for like being here.
Now, the world does use, you know, not to sound too ethnocentric, but the world does use the US as the, sort of the risk-free rate du jour, but, you can understand why some people might not. But essentially, it's again, it's the comparison, that you don't do anything in a vacuum. You're not investing in real estate, living in your little real estate bubble, and not being conscious of what the other opportunities are to invest in your capital, right? So we have, what did we talk about last week? Stocks, bonds, treasuries, right? All of that has an impact on real estate. Why? Because if I can go buy a US Treasury bond, so bond is something that's backed by the government, right? In this case, the US government that secures it. They have an obligation to pay you X percent, a dividend, right? That you get over a period of time, where you are lending them essentially the money, right? You're lending them the equity. That risk-free rate is comparable to what we would get as an investment income from real estate. Because I'm sitting here, I'm working for CalPERS, and I have $100, I can go buy a bond, or I can go invest into real estate. So that's why we're looking at all these different parts of the puzzle. Because as good investors, we need to understand, where does the real estate fit in the larger scheme of things? And are we getting paid for the risk? Because a treasury bond you can trade, you know, in minutes. Whereas real estate is way, way, way more difficult. Okay? I don't know if I'm covering too basic here, or this is, it's okay? All right, a lot of you are nodding, all right. We'll get into more interesting things, but I wanted to make sure we all are on the same page with this. It's really, really important. And in fact, I read the Financial Times. Financial Times is a London-based paper, published paper, and you get it here. And the reason I do is because it's much more a global paper than, because I work globally, and I did anyway. And I just feel like we should know what's going on in the whole world, not just from the US perspective. Go turn on the TV and the radio and hear, or whatever, and hear lots of people talking about things. But look what this was in the other day. I saved it for you guys. They have a Financial Times management, like on, what's it called? Financial investment management or something. Anyway, the headline is Negative Yields Investment Chiefs weigh in on a potential bond bubble. And what they're saying is, this was quite shocking, that, here, about 30% of the bonds issued by governments and companies worldwide are trading at negative yields. 30%, okay? Which means that $17 trillion of outstanding debt is being paid for by creditors. Is that unbelievable? That's where we are, guys. That's incredible. So when you look at something like this, that a third of the bonds from corporations and governments are not paying, if you buy their bonds, what does that mean? If you buy their bonds, it's a negative return.
So it begs the question why you're not just parking it in like in a savings account at that point?
Right.
Like, who's buying all this stuff?
Right, well, because you have these very large financial institutions like the CalPERS, you spoke about California Public, I can keep repeating this until you like get it. California Public Employee Retirement Systems, the largest pension fund group in the USA, has to diversify. So they can't put everything into a savings fund. Now, their actuarial rate, remember we discussed that they have to get a certain return to meet their future liabilities, and it's like 7-something%. So they can't afford this. So it's going to make them what? Make some maybe not great decisions.
Start taking more risk elsewhere to hit higher returns.
Compensate. They can't get out of bonds totally. These pension funds typically were very, very, very conservative. And a lot of them for many years were like completely in bonds. So it's like their history. But this is, so how does this impact real estate?
I would think there'd be more competition amongst institutional investors for real estate opportunities, considering that if they're having to put, let's say for example, 30% of their portfolio into a negative percentage investment, they're gonna have to make up that investment somewhere else.
There'll be more capital being attracted into real estate.
Yeah, they gotta make it up somewhere else in real
Is that what
estate.
you're going to say, Alan? Okay.
Those are more riskier investments.
Right, but also, so what happens, that's okay, what happens to the spread? So, what do we look at? Remember, everything's on a comparative basis, nothing's in a vacuum, everything's comparative. So we're going to look at is the yield on bonds versus the yield on real estate. So what all of a sudden happened? Right, so real estate looks what? Much more, exactly.
Doesn't ultimately lead the spread to compress in the long run though? If you're attracting a lot more money
Well,
to it, it's gonna
okay,
put more
so
pressure
that's
downwards.
part of the, the trick what we all get paid to do, to forecast. This is a moment in time to stay like this.
Yep.
Although, look at what's happened, the interest rates have been so low for how long? Right, and then we kept saying, oh, this year, you know? So, you're right, but meanwhile, today, and then we can look at forecasting, and which we're going to do. We're going to look at forecasting and how do we then start to judge all of that. But this is a critical piece that I promise you a lot of real estate people aren't necessarily thinking about, but they should. Look at that, wow. Anyway, I thought that was really interesting. So, I should move through this slowly. All right, and then we want to look at local capital markets, local partner risk. How do we find a local partner? We're going to talk about that in a place like Vietnam.
Is there a way that you can zoom into that, or?
You know, I was trying to do, if anyone wants to come up
It's on
here.
the option.
You think it's up here? I'm trying to do that. Over here?
Not, the three dots you see on it. On the-
Oh, yeah.
Zoom.
Zoom.
That's
Still
the
not
plus
great.
one. That's the plus one.
Yeah.
There we go. Thank you.
So sorry.
No problem.
Is that up in here?
Yes.
Okay.
Much better, thank you.
Okay, no. It's, everything's posted also. So it's under, I put it under resources, under classes and then resources. And plus the reading is there too, you'll see as well, and plus the reading materials and the syllabus and So local partners, you go to a place like Vietnam, how are you going to go find a partner in Vietnam who you trust and get to know? We talk about all of that. Real estate market fundamentals, things change, okay? So the cycles will change. And where are industrial buildings compared to office buildings and their cycles, and how do we start to look at that in putting a portfolio together to balance it so it makes sense? Okay? So these are the different elements. And look, for the assignments, a lot of the answers are embedded in what we're going through, okay? So you can go back to some of this and pull out a lot of this for help and guidance in making certain decisions. And I will help as well too, but I'm just saying that this is a lot of what we're going to keep repeating, and it's very simply stated right here for you. Oh, this is interesting, transparency. Why do we care about transparency? What is transparency in real estate from a global perspective? Oh, would you rather be paying?
You're talking about valuations?
No.
Liability?
Information, access to information. Certain countries make you record deeds, mortgages, others don't. How do you get information when there is none that's recorded, that's of state of the art? That kind of country has a much harder or higher risk, I would argue, than, let's say, the US. So that's and there was actually a company I worked for, we did a transparency index. We actually measured, and we will look at that together to look at what are the different components that make up information and access to that information, and how do we compare and contrast that in various countries. Okay. So we started off last week by talking about diversification, as we've been saying. So the correlations, we said what? One is what? 1.0 is what?
The high correlation?
Right, that's the highest correlation you can have. I'm perfectly correlated to myself. So I'm 1-to-1, right? So, and you can see here, MSCI World, 1-to-1. So that's the highest correlation, it's the same thing. So it's the highest correlation. What we want to see in a portfolio is negative correlations. The higher the negative, the better it is for us. It means that the two things that we're measuring are moving in different directions. And that's what's going to give us the buffer, the security, that cushion, that one's going to behave different. When that global financial crisis happens yet again, one aspect will behave differently than the other one that we're comparing to. So in this instance, we're looking at, let's say, global REITs compared to 10-year government bonds. Those two things I'd like to have in my portfolio together, because they do different things, they will behave differently. Okay? And versus direct real estate and global REITs, in this instance, has, a high, and it's not a great correlation in terms of negative correlations, but it's not perfect either. So it's sort of in between. Okay, we started to also talk about last week indices, right? So pay attention, because we're going to get some homework on this one. So why are we looking at indices? What is an index? So an index is something that measures a basket of assets. Okay, so it could be stocks, it could be bonds, it could be REITs, it could be private real estate. And what we discussed last week was that private real estate is a lot harder to measure because it's exactly that, private. Whereas the public markets, each of these companies has to report publicly, so you can go online and look at their 10Ks and analyze what they've done and their reporting of their returns and all that stuff. Whereas private real estate, really hard to get. So remember we mentioned that there was IPD, which created an index out of the UK many moons ago, but Morgan Stanley bought them, so it's MSCI IPD. And IPD actually went and goes and measures individual real estate assets. Okay, so it's a great tool to look at in terms of how private real estate is performing. Now, there are other private real estate indices. I mentioned one with NPI from NCREIF, remember that National Council of Real Estate Investment Fiduciary that does its NPI index? However, how they gather the information is they ask the investment managers to report into them their results. So it's a little bit of self-reporting, and as we discussed, how do you measure an IRR, one does monthly, one does annually, whatever. So I personally like the IPD, but we will still follow and look at NCREIF as well, because of different pools, and each of these indices have indices. So they'll have one for Asia, one for South America, et cetera, et cetera. So you can really slice and dice this. And this is what I meant when I started to say before, is a lot of information out there. So you can access this to see how real estate is actually behaving, both in the public markets and in the private markets. So, and we're going to go through a lot of this today. The assignment is really for the entire class, period. It is for each of you, but it's for the entire term. What I want you to do, and I think today will be a good time to start this, I want you to pick 3 indexes. I want you to set up a spreadsheet, Excel, follow them for the term. And the reason that you're doing that is because you want to start to hone your forecasting skills. So I want you to be thinking about which indices provide what you think is really good information to be able to forecast how real estate's going to behave over the next, say, 12 months. Okay? And we can talk about it next week too, after you've tortured yourselves trying to think about which 3 you want to focus in on. And if you want to do more than 3, but I want you to pick 3, but you can do more than 3. And you'll tell me which of the 3 that you chose, and then you're going to have to defend why you chose the 3. Okay? So here is a good sample of what we'll just be talking about. Here's the IPD Global Property Index. And I sent you also, I sent in the reading for this class, I did also send you the IPD link that you can look at. It's an older one. I think it's a paper that they did like in 2014 or something, but it gives you the gist of how it works. So here again, what Invesco did, who's a real estate manager, has private real estate funds, they're looking at comparing what bonds, REITs, stocks, and private real estate. Did you all just follow that? So IPD is a private real estate. MSCI, that's Morgan Stanley something international, that's bonds. And FTSE is actually Financial Times REIT index. And then Barclays is its bond index. So we're thinking globally, so you might want to think about when you're thinking about which indices you want to choose, think about global indices as well, okay? And so what they're looking at here are correlations. So looking at this, yep.
Sorry, what's the difference between IPD and FTSE?
So IPD is private real
Okay.
estate, okay? And what was the other one? NAREIT is publicly traded REITs. A good question. So, which ones would we like, if we had to pick 2 of these to put in our, we were buying the index, right? So you can actually buy the index, which is which stocks would they choose. So if you were going to buy the index, or indices in this case, 2 of them, which ones would you think would be good ones to put together.
Custom IDP Global and Barclays Global,
Exactly, and why is that?
so they have the, I guess, lowest negative value, so they're the least correlated with each other, meaning they're good diversifiers.
Right, so we said the highest, the
I didn't think about a highest or lowest.
the high, it's the worst, it's the negative, the highest negative number produces the best opportunity for pairing because the two things that you're comparing are moving in different directions. Okay, whereas one is perfect, right? So the way to remember to look at this, whichever one is one, you'll see that's the same thing, right? So that's the clue. That's the biggest clue in these kinds of charts. Okay, so does that, yeah, go ahead.
But we're looking at always the lowest risk, right? Because if we were going to pursue like highest yields or dividends, we would, like, for a short time frame, we might choose like positive correlated.
Well, but that's a really good question that you're raising. And your name is again?
Alejandro.
Alejandro, sorry, okay, Alejandro, thank you. So Alejandro, you're raising a very good point, because you're saying that with this bond situation, like how players might be motivated to go get extra return from someplace else and make some higher risk investments. Because they need to be able to pay their beneficiaries at the end of the day. So it could be that you do want the highest risk. However, you want to make sure you're getting paid for that risk. So this isn't to say that you don't take risk. Everybody takes risk. You walk out into the street, you take risk, right? It's how you control that risk or manage that risk so that you're getting paid for what you think you're taking. Like firm I was with for many years, LaSalle, we were one of the first groups to go into Asia to invest. And this was back in like 2001. Oh, right, it's the anniversary today, right? We started to raise money for one of the first Asian real estate funds in 18 years ago. 18 years ago. And what happened was everyone loved the idea. So we had a lot of, our parent was in Asia for decades. So we had a lot of on the ground direct information in real estate, a great story to tell. It seemed like it was a great time to start to think about that. Nobody else was really doing it. And we were projecting at that time like 20% returns. But what happened was September 11th happened. And every investor that we spoke to went like deer in the headlights. Stopped. Because of this major global, at that point, thinking, political risk. People calmed down. We did raise several $100 million, but, and so we were taking a very high risk because nobody had done this before. We were investing primarily into Japan, Korea, Japan and Korea primarily, and other countries as well. But we were taking very high risk, but what we did was we went to more of the developed countries in Asia first. So we were managing the risk of moving into Asia by saying, okay, we're going to go into more of the developed countries first. We weren't going to do development, we were buying existing buildings, I mean, there was a whole list. So we were saying we wanted the high risk. We were opportunistic investors, but we were going to manage how we were going to do it. So that's the answer to your question of yes. And do you know what's from the efficient frontier is? So that's the perfect portfolio, and we'll look at that. The perfect portfolio looks at what is the highest return you can get for the amount of risk that you're taking. Or said in the reverse, the other way, what is the lowest risk you can get for the amount of return you need to get. And you can actually plot that and figure it out. So that's why you need to do all this stuff. Okay? Alright, so, I'm very slowly here, I'm sorry, but hopefully I covered a lot of information. So correlations, now look at this, look what I found, I was so excited, this is Invesco again. This was, okay, so it's the IPD Global Property Index with private real estate, and it looks at all these different countries' correlations. So Invesco does, real estate investment portfolios globally, privately. They do REITs, they do investment REITs as well, but they look at investing in all these different countries, and they're saying we need to look at how these countries relate to each other. So again, which countries would you start to think about? Can you see all this? Oops. Last time I was able to get this. All right, I'll figure it out. But anyway, so from what you could see on the screen, which countries would you start to think that would make sense to bring together?
Hong Kong and Germany.
China and Germany?
Mm-hmm. Where's Hong Kong? Oh, there's Hong Kong. Hong Kong.
Pretty much it.
Yeah. Mm-hmm.
Not as good with Japan and China and Japan and.
Isn't
Hong
that
Kong.
interesting? So Japan and China, both in Asia, last time I looked, right? And so different. And why do you think about that? When you think about that, that makes a lot of sense actually. So Japan's the number 3 largest economy in the world now, but very much developed, whereas China's very much developing, even though now it's the 2nd largest economy in the world. So that is really important to think about in terms of building out your global portfolios. And you might, when you do that, when you build out your report, you might bring this chart to your presentation to show how these countries are relating or not relating. But that's how these investors are looking at this. You know, you need to defend it, you need to build it up. Remember we discussed last week the Sharpe ratio? So what was the Sharpe ratio? Measured risk and risk-adjusted return. Remember? We said that it's not just the return that we're worried about, it's looking at how much risk we're taking for that to get to that return. To your point, Alejandro, exactly that. How much risk are we taking to get to that return? And there's a formula. And so the formula is your return is 25%, right? So it's the return minus what? The risk-free rate. So let's say the risk-free rate was 5, so that's 20. And then divided by, what's a good measure of volatility of risk?
Standard deviation.
Exactly, thank you. So divided by, let's say, so where it says 25 minus is 20, minus divided by, let's say it's 10, so it's 2. Higher Sharpe ratio, better it is, because why? We're getting more return for the risks that we're taking. Now let's take a step back and just look at that standard deviation again. So standard deviation measures volatility, right? Because why? We look at the average return, and then we look at whatever it is we're looking at, how much it's away from that median, right?
Yeah.
So the further away, the higher volatile. Oh, is that right? Yeah. Higher volatile it is. We don't like that, right? So we want a smaller standard deviation, a smaller volatile, smaller move away from the mean. Does that make sense? And you could add your Sharpe ratios to what you're doing, right? Because that's going to really help you thinking about the 2 things together, the ratio, the risk and the return. So, and I put this in here because you can read it at your leisure. But how I described it is much easier. The other thing is what's called the Sortino ratio. The theory behind it is, and you're never going to be tested on this, but you should just sort of know it for yourselves. Sortino ratio looks at the downside volatility, so, or the downside risk. Whereas the Sharpe ratio looks at volatility going either which way, right? The plus and the minus. The Sortino just looks at the downside because it's some people's thinking that the positive volatility, just because it's further away, doesn't mean it's a bad thing,
Yes.
right? So that's the theory behind the Sortino, is that just because the standard deviation is higher, but it's on the plus side, it's not necessarily meaning there's a lot more risk. It's not necessarily bad. You all with me? Okay. Any questions or good questions? Okay. So then we started to look at this, putting it all together. Remember the return, the standard deviation, and then the return per unit of risk, or in this instance, the Sharpe ratio. Right? So we say you can get a great return. Let's look at the NAREIT equity REIT index, 12.8%. Now, so if you just looked at that, and you're making investment decisions, you'd be like, oh wow, that's good. I'm all over it. I'm there. However, what kind of risks are you taking to get to that 12.8? Pretty high risk, right? That's standard deviation. Now, we just learned about the Sortino, so we might look at, well, is that good or bad volatility, but putting that aside, there's still a lot of volatility to get to that 12.8. And plus, we're only getting 0.7 return on the risk that we're taking based on that volatility. So what it's saying is, we're not really getting paid that well for the risk, the amount of risk that we're taking, because it's a lot more volatile. So you should never look at just the return in a vacuum.
Question, with regards to risk, how come we see volatility as the only factor of risk? Because if I invest for the long term, I really don't care if it goes up and down on a yearly basis, right? As long as it consistently goes up in the future.
Look what this is. This is from 1978 to 2010.
Oh. Yeah. Very nice.
One for the teacher.
Fair enough.
Right? So you can look at, the point, it's a good question, but you can look at any period of time. And if you're right, then you should be looking at that. And that's why sometimes I'll put up repetitive charts showing different periods of time, because I do like to look at, well, what happened in this period, and this period didn't have any recessions, but this period did, how did it behave then?
Fair enough.
Right? Did you have a question about that?
Yeah, so it will be attractive if the Sharpe ratio of NAREIT will be 1 or higher than 1.
So one is for the correlation, okay? Standard Sharpe ratio is just, the higher the number, the better. Because we're getting, what it says is, how much return are we getting for the amount of risk that we're taking? So the more return we get, happier we are for that risk. So it's not like 1, or it's not like 1. It's just.
There's no typical like.
Well, there is. It depends what you're looking at, though. I don't want to give you. But it's just think the more it will be on a relative basis based on what you're looking at. So in this instance, these are the numbers for these different indices that they're producing over this period of time, right? Over a long period of time. So in this instance, the bonds, look at that, 8.3. You get 1.2 compared to the rest of them. That's pretty good, right?
When you're looking at that long of a period of time, you want your investment to be at the standard deviation or higher, right, on the average?
You're right, because you don't want, the standard deviation again is the volatility,
Okay.
right?
Yeah.
So you don't want to, okay, if you just take a step back for a second. Okay, there's bonds, there's real estate, there's stocks, equities, right? So bonds, you contract for 5 years, 10 years, 3 years, 10-year bonds, whatever, and you get them to get paid. No matter what happens, you're getting paid. It's a commitment to you. Same thing for real estate, sort of. In terms of you get a lease, you get an income stream, right? Now, each real estate will be different, but generally speaking. What happens in the stock market?
It's volatile.
Why? It's traded every day.
Liquid?
It's liquid, but that's not why it's volatile. It's volatile because, well, I guess
I mean,
it is,
people,
yes.
like, it's also very impacted by like
Right.
investor sentiment and other things
Look
like
what's
that.
been happening to the stock, could you go nuts like these last few months or whatever, it's just insane what's going on in the stock market. So it's because it's traded every day. A bond, you contract with the government or a corporation for 3 years, 5 years, that, I mean, you can sit there and not do anything. Now, if you wanted to sell it, the value would change based on the interest rates and what's going on in the marketplace. But you could sit there for the next 10 years and just, what they say, clip your coupon and just, put your feet up and you're done. And let's say you had a piece of real estate, industrial piece of real estate, and you had a 20-year lease. Now, okay, obviously there's a risk of the tenant going bankrupt, but putting that aside, again, you're sitting there, you're just getting, the value, you're indifferent to the value because you can sit there and not do anything. Whereas in the stock market, every day that value is changing. And do you follow any stocks at all? I'm sure some of you do, right? You see it change like every freaking day. It's crazy, right? So that's the volatility. Because it's liquid, I can buy and sell. It's an open public market. It's like standing out there, who wants to buy this? And someone comes up and, yeah, that's it. So that's why the volatility for stocks is always going to be, well, not always, but most instances will be much higher because of that movement. But you're getting paid, but you're getting benefit of the liquidity, that you can get in and get out. It's not going to cost, well, it might cost you because you lose value, but it's not really going to cost you in terms of like lawyers and, title insurance and all this stuff, like in real estate. Does that make sense to everybody? So here, I don't know, I'd be very happy buying that bond index, personally. And so the NCREIF is a property, that's a member of the National Council of Real Estate Investment Fiduciaries, private real estate index. So private real estate is only, 60 basis points more in return than bonds for this period of time, and a lower Sharpe ratio, only by a drop, but still lower. I don't know, my money is in bonds. You might leave this class at the end and say, forget real estate. But I doubt it. Okay, this is more the same with the REITs and stuff. Okay, so I think we spoke a lot about all of that. So now, let's look at real estate from the perspective of the returns. I'm just going to talk about the returns of the other asset classes on a comparison basis. But what is it that makes up the return in a real estate deal?
The income.
Well, yeah, but so if I said to you, you're getting a return of 12%. So there's two components of that 12%. Well, it's really three, but
Income, appreciation, and tax benefit.
forget the tax. But yes, income, right, so income and appreciation, right? And the income is something that's being thrown off by the property. Appreciation is based on future projections, potentially, or when you sell, the actual valuation, what that real estate can grow by. So everyone thinks there's always appreciation. It's funny, we say income and appreciation, it should really be income appreciation or depreciation.
Yeah.
Because it could be that the value goes down by the time you want to sell. So income is equivalent, as we spoke before, about bonds, right? That's the income, the interest rate that government or corporation commits to pay you for the loan, essentially, of this equity that you're providing, and you get that return. Same thing, piece of real estate. Buy a building, you have the leases, and you expect to get a certain amount of return from income from those leases, then minus the operating expenses and taxes and all sorts of things. which do you think is a larger piece of the pie typically in real estate, income or appreciation? Right, and isn't that really why a lot of people buy real estate? It's for the income. And, you know, I would position that it's dangerous to buy real estate based on appreciation. We all do it, we all think about it, but you can't go to the bank with it. So what's interesting here is, looking around the world, we're looking at, and this is also a long period of time, 2005 to 2017, the annual average income returns and capital growth returns. So you can see most of it, for the most part, are income returns. Italy actually has some depreciation there. And look at South Africa as sort of the outlier, and Hong Kong also, as the outliers for appreciation opportunities. So again, when we're thinking about putting a global portfolio together, this is something that we want to look at. Where are each of these countries on a relative basis to each other in terms of providing income and or appreciation, or lack of appreciation, or lack of income? And what's also interesting is that for the most part, the income levels aren't that different from each other, are they? So much for diversification, right? So that's something to be very aware of.
May I ask why India's not on most of these charts?
That's a good question. We have, it's interesting. Well, I'll tell you what I would guess as one reason. I spoke before about transparency and trying to get information.
Very true, yeah.
India is one of the most,
Tourist is difficult to get
it's
information.
very, very dispersed in terms of little regions that are then built up together, and it's very hard to get information. So that could be one of the reasons. And I know at LaSalle, India was like, we didn't invest in India, we hadn't invested when I left in 2007. It was 2007, we hadn't invested in there. And we had invested in like every other country in Asia. And we were just really concerned about partially that. So, and then here we have, here's the total return on a comparative basis, global equities, global listed, global unlisted, global bonds, and then the risk volatility by standard deviation. So, the income, you can see, like the global equities for the risk volatility, it's pretty much non-existent. So as we were saying, that the risk and volatility levels for equities is about the growth of the value of the stock. REITs provide somewhere around, I think it's about 4% dividend that they have to distribute. That's partially what a REIT is, the tax structure, is they have to distribute things like 98, 99% of their income. But their dividend rates are somewhere around 4%. So it's okay, it's not bad. It depends though on the appreciation levels in terms of income, but this is exactly what we're talking about.
How's the every country currency affect like the?
That's a good question. So it is called what's PPP, Purchasing Power Parity, and what that does, it creates a basket of goods and services, and it takes away the currency, it flattens the currencies. So it just looks like, how many apples, if I'm in Italy versus I'm in Germany versus I'm in China, how many apples can I buy for X? So the X is, the currency is flattened, and how many apples do I get? So that's how they look at it. Now, here, they would have to adjust for currencies in these kinds of indices, and they.
So this is not dollars?
Says the returns are in local currency.
I think it has to be in local currency.
Okay.
Yeah. So, yeah, but you could look at up the PPP in terms of trying to just flatten things when you look at it. And we're going to spend a little time talking about currencies as well, and the risk that's associated with them. Okay, so talking about returns and things, so now we're looking at the 10-year treasury rates. What has it been, where's it going? So this looks at 10-year treasuries somewhere between, say, 2 to 4, 4.5%, 4.7%. And I think these are, this was done a little while ago, this is high now, the 3.2. We're lower, I don't know what it is today, I didn't look, but it was like 2 something last week when I looked. So treasuries are in that 2 to 4 range, let's say, give or take. Just to keep that in perspective and looking at it always from a historical, where are we? So that would compare, if we're thinking about returns to real estate. So again, this is the, NACREIF is the private real estate world, and capitalization rates is what?
NOI over
Value per square foot.
That's like the return on your investment, right? That's what the property is throwing off in terms of an actual return. So we just looked at that. So look at that for a second. So let's say these numbers are right. They're not the 2832 and 232 versus 515355. What is that telling us? So figure 3 compared to 5. Pretty simple. And look at this. This is the 20-year average for private. This again, private real estate was 6.73 compared to 10-year treasuries of not quite 4%. So what are you looking at as the cushion between the treasuries and the real estate?
2%.
Right, 200 basis points. Is that a lot? I mean, think about that. Sort of noise, right? Considering all the risks that are involved with real estate, wouldn't you expect a lot more?
I think it depends too on which real estate you're talking about. Like, for example, if you're talking about like a Class A office building in
Then it's
Midtown
1%.
Manhattan, or it's
Right.
a totally different story. And then you also might be thinking like it might be a dangerous game, but maybe some of these guys are looking at potential long-term appreciation as part of their
But
return.
NACREIF is typically these private institutions, these investment managers that are investing on behalf of a lot of these private institutions. So these pretty much these core kinds of real estate, maybe a little value add here or there, but pretty standard good stuff.
Yep. So
it's somewhat surprising that, if you're thinking about investing your own money, would you want more than 200 or 2%? The difference between what you could take that $100 and invest it into bonds, U.S. Treasuries? Wouldn't you want more than 2% for all the work you're going to do? I wouldn't put it for 2%. Forget it. So, at the end, you might come back and say, well, we're not investing in real estate. But these are the things you need to be thinking about. And then looking at the treasury rates for the different countries that you're going to be thinking about. This is just very U.S. focus. Cap rate. This is retail. So this is to your point that, so here, the 20-year average is 11%. Oh, that's a lot better. This is retail, right? Total retail returns. So also compare 11 to, what did we say, 3%? Yeah, almost 4%. So that's now getting some, but look what's happening in retail now. So, that's part of the story. So the cap rate spread over treasury, so this was back in 2000, but I couldn't find a chart that showed the two. So, so the 10-year treasury rate compared to the cap rate. And what this says is that, in addition, the average cap rate spread on NACREIF property transactions versus 10 years more than 100 basis points above its long-term average, and the long-term average was like 200 basis points or something. No, it was more than that. No, it is around 200 basis points, plus or minus. So, it speaks to though, when you're looking at making an investment, where are you in the cycle? And not just to say, well, vacancy is this, it's to look at this too. Because everybody has options. So this is private core cap rate to 10-year treasuries. Oh, here it was, spread cap rate minus 10-year, 20-year average spread is 250 basis points. So you wanna know, are you above that or below that? And where are you in the cycle from a financing perspective, from an investment perspective, not just from like a occupancy vacancy. So 250 basis points. Still, I would still argue it's not a lot. When you start to lay out all the different risks, and then you look at the Sharpe ratio and the volatility, especially now I'm walking out the door. By the way, tell me when it's 7:30 and we'll take a break. Oh, it's 10.
No, it's always that
Oh,
time.
all right.
Exactly 7:30.
Okay, do you wanna take a break? Or you wanna wait a little? You, I think we're going slow. Take a break, thank you.
You only actually get 2 electives outside of
Yeah,
your
so we can go
concentration,
back.
and there's
Is
so
that right?
I just saw,
Yeah.
the bottom left
So
side, she made
you
it.
pick your
And then I
concentration,
figured
and you
out,
have
okay,
4 required
we were
courses, and that on top of the
sacrificing
8
I came
lower
back.
courses you're required to take, and then there's
Yeah.
2 electives, and
wrong.
there's, I don't know, probably like 12 classes I wanna
I
take.
like that restaurant.
So it's kind of like,
Yeah.
at that point, what classes are most interesting and what fits your schedule? Just 'cause there's
But
so
I
many.
think more of a schedule than anything else, and then it's
So
like,
what,
what's,
so what,
you know.
what is in your book?
Past,
What's in your
what's
book?
shameful.
Shadow?
Yeah, pretty much. Just
Right.
kind of creative ways.
No, my
That
numbers
is,
keep changing on the roster, so I don't know.
My goal.
Well, I'll
I
stop,
want to achieve in my
after this
head.
week. I
That's
think
what
the
I
ad
was thinking.
drop
Creative
thing
ways.
stops in a couple of days. Some
Right,
people are
well,
still.
that's what seemed to be, so
What,
that's what happened to me last
what
time,
is,
is like, like a bunch of people registered for it, but then nobody showed up.
What is,
So people over-register for
what
classes,
is,
I'm hearing,
let's-
and then you can sort of go and
Listen.
test and see what
Yeah.
you like, and then like not go.
You also, like the class registrations, like, I think this was in April or May for this semester it started. So you do it back then, and then you might go to 6 or 7 classes in your first week, see what professor you like, and then
Right,
Yeah, they're just
change
Right.
it all up, so.
and I've asked some students, like, do you ever look at like the ratings of the professors?
Every single class I've taken, I've, tried to get opinions on the professor from somebody. I know who's been in the program, or the Facebook group where everyone talks
But you
about
don't look
professors.
at, you don't look at the ratings, cause I get rated.
Well, some teachers don't have them, some do. Wait, do you mean like the ones that students give in?
Yeah.
I don't think we have access to those, I thought those
Yeah,
were just for you guys to.
There's some NYU professors that you can look up, but a lot of them here in the real estate program unfortunately can't.
Really?
Yeah.
Oh, I thought that everyone saw that.
I think that's more for like a,
Just for us?
for you guys and for NYU.
Oh.
Like I try to go and like rate my professors or something, but nobody's on that really.
Yeah, no one's on that.
So it's kind of word of
Because I
mouth.
was so proud, my last one, they used to, like, okay, this will help me now.
No, it's word of mouth.
But,
Almost nobody's on.
so now who cares, okay. Alright, so now I
All
can
for
make
nothing.
offers to you guys, it doesn't matter.
They're meaningless.
We'll be the first class to spread the good word. don't
There
worry.
you go. No,
So you're
I'm
shadowing.
still in contact with some of the students from the first
Oh, okay.
semester, first term that I
Like
taught.
in the
So, no, I think it's a nice friend.
She stands up for herself. She's like, I've been your assistant for my.
I think I give you a great mark, but.
I've been taking care of shit.
Okay, now I might drop
You
it.
make sense. So that's how like she'll come and she's on.
No, it's all good, everyone works hard. That's what's been impressive, everyone really does try. But it always makes me concerned because I see some people don't get some of the concepts. And I try really hard to make sure, but I never quite know until.
It's too late.
It's too late, never too late, but, you know, seeps, so.
Well, I'll tell you, for me, the concepts are difficult because it's a different perspective. So because I work I'm mostly looking at operations all the time, making sure that they're performing. And when I look at our stock valuation, I'm looking at, the competitors of our stock and, how's that gonna affect our brand and, where is operations gonna move to? So for me, this class, I have to change the mentality and the mindset from a real estate investment standpoint, which is a little hard.
No, you won't
Say
though.
that.
This is all going to come together.
Yeah, I could say
It's
that.
good to change the channel.
Yeah, it is good,
It's healthy.
yeah.
And what you just said, when you're looking at comparison of the stocks in the same sectors,
Yeah,
that's what we're talking.
yeah, it's just a different perspective.
It's additional information that I think will give you some other interesting ways of looking at what you're doing.
Yeah,
What, can I ask you, what kind of manufacturing are they doing?
you'll remember, there was
Oh,
a company
no.
called Avery Dennison. They used to make the sticker labels, and they were really big in office products.
Yes,
They
Avery, of
sold,
course.
yeah, they sold the office product, but then, they went heavily into, one segment is the retail business, where they make all the labels for all the clothes, all major
Oh.
companies. And then they make all of the, like adhesive on buildings. So if you think about peelable, building signage, they make all of that for all the major companies.
Wow,
And then, they're going into RFID. That's a label technology, so we can track inventory.
interesting.
Yeah, it's a really big company, a lot of people,
So this is
Like
like
it's
great
small.
in logistics, I love this stuff, logistics industrial user.
yeah.
So do you own most of your real estate or you lease it?
We own the assets where we know that the business is never gonna change. And we
Wow.
have a really young CEO, so he's really aggressive with his approaches. But we,
Interesting.
for the first time in a long time, we're gonna look at buying assets next year. So for me, a lot of this information is really useful because markets like India, China, Vietnam, it's very difficult to look at the foreseeable future, and someday when I'm not there anymore, I don't wanna leave somebody with some of the
Yes.
assets that I have now, which are extremely difficult to sell, and most of the time we take a big loss.
See, so there's always a shift in these kind of industrial users of, we should own everything, so why should we pay rent? Then there's a shift and
Mhm.
things happen in the stock, to the stock prices and things, and also they need the equity, oh, let's sell all the real estate and let's rent. So that you can watch the movement across the board for a lot, and you're global, you said,
Yeah.
in Asia as well.
Yeah, mostly Asia. So of my footprint in North America, it's under 100 now,
Mm-hmm.
and the remainder is all Asia, and growing in Asia.
Well, that makes the most sense.
Yeah.
So this is interesting, so this is another kind of role one could play in global real estate by working for the user.
Yeah, I like it.
manufacturer.
It's great. I
Mhm.
really like it a lot.
So, and we'll talk about career paths thinking globally, that then there's the investment manager, and then there's a lender, and then there's all sorts of pieces of this puzzle you can look at in terms of where you could position yourselves to work that could have a global context. Okay, that's it. Okay, so GDP, what is that?
Gross domestic product,
Right, and what is it?
all of the output that a country makes in a duration of time.
So we could use that as a real, measurement to compare countries in terms of growth, right? So we should understand what goes into GDP, so we have a better view of what it is, and what is it telling us about each of these different countries' economic growth paths. So here's a nice little chart I found that speaks to the different parts of demographic changes, economic output, employment rate changes, reallocation between employment and manufacturing, let's say, and office, changes in capital labor ratios. So these are just some of the pieces of the puzzle that goes into thinking about GDP growth. So here's some looking at employment and productivity specifically. And interesting how productivity and employment don't always move in tandem. And so what would that tell you about, how would you relate that to real estate? Your unemployment's going down, but your productivity is like over here. So your employment's going down, but your productivity is going up. So what happens there? Sorry?
I was going to say automation.
Automation, right, that's right, exactly. So how does that impact real estate? Why am I thinking about that?
The less of the number of people would wanna.
They need what? Less
Houses.
space.
Industrial space.
Less space, right?
Yeah.
So, well, this is productivity, thinking more for industry as opposed to residential. But it does impact residential because if fewer people are employed,
The agglomeration down.
right, right, those fewer people have money to then go buy houses. So the productivity is very key to us in thinking about real estate, and the same thing for employment. And so the productivity, we don't want it to go up too much. And although years ago, I worked on, it was a building on JFK that was for distribution from a German company, and you had no people touching anything in the building. You had everything coming to the building, and everything was automated, so it got off the boat or whatever it was, and then got into the building, got distributed automatically, and filed or whatever, stored, and that was it. So it could be that productivity isn't necessarily overly indicative, or employment isn't overly indicative for certain types of real estate. We can start to look at hires rate, job openings rate, quit rates even. I like the quit rates, because that tells us that people are either moving to another job, have enough financial wealth not to work, or are maybe starting their own companies. So we always look at the employment rates, or the unemployment rate we look at, right? And we say, oh, unemployment is the lowest, blah, 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 blah. Okay, it's important, and I get it, but I think there are other parts of that we could be thinking about that impact real estate specifically. Okay, so that was just a little segue, because I should move along there. Segue into GDP and how that impacts what we're thinking about. But back to the indices. So again, thinking about how you guys are going to pick 3 indices to follow for the term. Here's a nice chart. You can sort of look at this when you're figuring that out in terms of how they compare to each other, the public and the private. So the bottom axis is a 7-year volatility rate, and the top, the left-hand side is a 7-year annualized total return. Okay, so your return and your volatility or risk. So if you were to buy into one of these indices, which ones do you think make the most sense? And you have the colors, can you see the colors? The direct real estate, non-listed, real estate funds, and real estate equities. Do you know what this is, non-listed real estate funds? So what this is means non-listed, so it's not public, it's private.
The private REITs.
Right, so private real estate funds. So you have the likes of a Blackstone, or the LaSalle, or the JP Morgan, creating pooled assets of real estate funds. Like we spoke about this building, 11 West 42nd Street, where we're sitting last week, remember? We said that it's owned by Tishman Speyer, But I said to you, well, Jerry Spider doesn't own the building, he probably doesn't have any of his own equity in the building. So what do these investment managers and banks and insurance companies do? You've heard of mutual funds for stocks and bonds, where the manager picks a strategy and then they go and put a basket of like kinds of bonds or stocks in that basket. Real estate managers will do the same thing. So we create, so most of the real estate that you will look at, walk around in Manhattan, are in these different funds. And it's a fund that will say, there's a core strategy for owning, central business district, CBD, office buildings, Class A, and we're going to project to get a return of 7% or something. And 75% of that will be income, and 25% of that will be appreciation. And then they will go to these different pension funds that we've been talking about, and sovereign wealth funds, and foundations and endowments, and raise equity, capital, to invest into this fund. And then these fund managers will then go and find assets to invest in. And the fund has typically has a finite life, although there's what's called open-end funds, which means there's no term. It's just you can go in and out, but there's some limitations to that. So conceptually, it's a mutual fund of real estate products, real estate investments of a particular strategy that will provide a particular return to these investors, and the investment manager manages it. And you're going to meet an investment manager. A friend of mine is coming up here one day, and that's what I did for a living, was essentially, but we will talk about the pros and cons of all that and how it works, because it's one of the largest parts of the industry that you all could participate to work in that field. So you hear about Blackstone and BlackRock and this and that. Like we spoke about Stuyvesant Town, Peter Cooper Village, and we said that Blackstone had 5.3 billion in that. Again, not Blackstone money, it's in a fund, I promise you, I didn't look, but it's in a fund. And there's a variety of different pension funds that give them the capital, and Blackstone goes and has the discretion to make the investments. And they probably put 25% equity in that deal or something, and the rest is debt. But these are the pension fund and sovereign wealth funds and insurance companies' money that they invest into the real estate. So you walk around, that's who owns most of this real estate, especially in this city. It's not any of these individual people or managers. We're gonna go off on that. Oh, so that's the non-listed real estate funds. So these private pools, right? And that's measured, again, by NCREIF. Where's NCREIF? Historically, NCREIF, NCREIF, the National Council of Investment Fiduciaries, are measuring non-listed real estate funds. In essence, private real estate funds. And then real estate equities, which is our REITs, right? So now you can see how all these different indices are comparing to each other on the risk and return scale. So which ones do you think would make the most sense based on this chart?
IPD one. Yeah, UNL.
So this one? So least risk, okay, that's good. And the APAC, that's the Asia Pacific, so I don't know if that's Netherlands or what. Okay. Yeah. This isn't too bad. Well, you're getting paid for the risk, it seems, right? So that's not too bad. But again, so here are lists of all these different indices that you could choose to follow from, right? And then I wanted to give you, so here's, again, there's indices for everything out there, it's insane. So you can go crazy looking at all this, and I don't suggest you do. But there are indices that will that follows quality of life. Now, you always have to question who's doing the index, for what reason are they doing the index, are they involved in the product? You know, Morgan Stanley has an index, but they're trading stocks. So always understand the pros and cons of what, and there's no perfect index. And you can look knowledge, talent, and innovation. I'm not quite sure how you measure that, but whatever. Okay, so then we're starting to look at, these are some indices for measuring cities in terms of the opportunity in these different cities. And that could be very interesting for you, right? Because you want to start comparing and contrasting some of these. And what's interesting is you can see that you'll have different, very different results based on which index you look at. So you have to dig, and I'm not suggesting to don't go nuts with this, but just whatever you're looking at, start to peel the onion skin to understand how they're measuring things as best you can. As best you can. But you know, for us that's important to look at, like the cities, the CIMI, the Cities in Motion Index. That's the level of development for all these different areas, including urban planning. Like that's an important, that could be an important tool to be looking at if you want to get a higher return. You're looking for development deals, you're looking for a city that's actually developer friendly, that doesn't, you know, torture you, that you have to go through zoning changes for 5 years. So things like that are important. And these look across the world, obviously, based on what the different cities are. So I'll give you a hint here. This is my favorite. This is a leading economic indicators index, and it's a composite, so I like it, 10 different leading economic indicators. And they bulk it up into, and it's done by this conference board, which is not for profit and arm's length. So I like who's doing it, and I like the fact that I don't have to look at 10 different indices. I can look at one and get a good picture of what's going on. Okay? So, and here, this is just looking at North America capital market indicators. So we have the leading economic indicators. We just, you know, and I'm going to spend a little more time on that in a minute. The other thing we can look at is the yield curve. So, yeah.
And just,
Oh,
man,
where's
sorry.
your pencil? Oh, sorry.
Just playing with my pencil, sorry.
That's okay. So that's going to look at the difference. Like everyone's been talking about the inverted yield curve lately. What is that?
And short-term rates are higher than long-term rates.
Right. And that's a problem because
Because it means that like people don't have faith in the economy.
right. So typically the long-term products, long-term bonds, treasuries are higher returns because exactly that. We think that we have faith in the future, and usually you get paid for holding something longer than for something shorter. CMBS issuance, that's an interesting one, right? Why do we, in real estate, going to look at that?
I think it probably says a lot about like the institutional market's confidence in the real estate market, because for banks to issue CMBS, you have to someone to buy the bonds, which are typically institutional investors. So if we're issuing a really low amount, it could be two things. There's not a lot of demand for debt, or there's no one willing to provide the debt. So either way, it could be, you know, a way to look further on either side.
Or it could be there's too much debt.
Or, yeah, absolutely.
Right?
2007.
We'll look at that in a minute. Exactly. Exactly. So, and then the transaction volumes in real estate. So here's where it starts to tie into the real estate marketplace, right? So we can look at the leading economic indicators, the yield curve, how much CMBS is being issued, and then how much real estate is actually being transacted on. You know, did Brexit cause a stop in the marketplace in London? For a very short period of time it did, and then it didn't. Okay, and then what happened was everyone, the bottom fishers thinking, oh, this is my opportunity to get in this marketplace. And then pricing relative to corporate bonds. Again, because we're looking at a comparative basis and how much capital costs, and how do we start to look at what we can do with our money. So this page alone, if you start to follow all of this and looked at it for a period of time, would give you a very good view in to analyzing where things are. So you can, this is your cheat sheet. So here is, we did this at LaSalle. And we looked at a monitor to indicate where we were and looked at various countries to do it on a comparative basis. So the green flag means ships ahead, all things going, all good. Yellow, be careful. Red, danger, okay? So we looked at, this is Australia, China, and Japan. Okay, those are the 3 countries. And we looked at what I just showed you, the different indicators. And you start to see the difference of where things are. So this is again a way of comparing and contrasting what's happening in the macroeconomics and the real estate transactions we have here, which are all over the place. So the top one, real estate transaction volume growth. So that is a way of saying, look at where things are. And it's interesting. So for Australia, it's like all good, all green. Japan, the same thing, but China this was back in 2014, were some caution signs. Now, looking at this, so this was 5 years ago. Could you say maybe it was wrong? I would.
I think with China, and I think a little bit with Australia.
So China had a lot more opportunity, so that's why you were seeing the yellow warning signs. There was more risk. But yet, certain areas in China, again, depending where in China and depending what kind of asset class in China, but you could have done a lot better. Whereas Japan was very, again, they had like over 10 years of no inflation and all sorts of things, but it was a safer bet. But yet the values in certain instances have gone down. So again, you can look at all of this and say, well, okay, this is what it's telling us, but I also know that there's more opportunity because we're going to look at the demographics and all these other changing dynamics in a marketplace to then say it's going to offset this. But you should know this to then have that discussion. So, and here's for Europe, both looking at supply-demand imbalance, debt equity imbalance, and then pricing imbalance. So, again, you're looking at some of the capital market critical data points in terms of, is there an oversupply risk, recession risk, corporate bond spreads, loan to value, bank exposure to corporate real estate loans, bank CDS spreads, real estate versus their bonds, REITs versus equities, and then 3-year IP capital growth index. So again, you can sort of break it down into the supply demand, debt equity, and then pricing, and look at that as a total comparison. So these are just ways of looking at all of this. Okay, and then you can also look at, so this is perfect for what we're talking about with the label company. New orders for consumer goods and materials. We're thinking about doing an industrial portfolio. Something like that would be really critical. Merchandise to vendors and suppliers, capital goods unrelated to defense, if we're not in the defense mode. Building permits, stock index, money supply, short interest rates, and consumer sentiment. All these things have a role and depend what you're specifically looking for. So these are the 10 areas that the conference, so this was here, what I said was my favorite, this leading economic indicator. So it says the basket of 10 different indices, economic index, of 10 leading economic indicators. these are the 10. So you can see it's including the stock market and money, you know, so it has a mix of both very tactical kinds of issues in terms of building permits and consumer goods and materials and even consumer sentiment, but it also includes the stock market, the money supply, and average hourly hours worked by manufacturing workers. So it gives you a pretty broad view of what the economy is looking at. So looking at how good are these predictors as predictors in terms of what is an index for, it's to sort of give us information to be able to do forecasting, so how good is it to help us with our forecasting. So this leading economic index that we just looked at, would you say it's a good indicator for recession based on this? Sorry, this thing is in the way. So this is showing how many months, so you're looking at when the recessions hit, which are the gray bars, right? And then you're looking at the blue, which is the actual index, this Conference for Leading Economic Index that we just went through, right? And is it pairing up pretty nicely from what I could see? So everywhere where there's been a recession, this leading indicator had dropped precipitously. So that tells us, yeah, this is something that we could depend on. Now, depends how much, but have some, if someone were to, if you were to make a presentation to an investment committee and you were saying, well, this we're using, and they said, well, why would you use this? This is part of the answer. That it has demonstrated to be a good predictor for recessions. And so here, and all 6 recessions since 1968 have been preceded by at least 3 consecutive months of negative spreads. Average yields in the 12 months before the start of recession. During the same period, these measures produced no false positives. So, what is that saying? What that's saying is that the spreads of the 10-year treasury to the 3-month treasuries, again, gives us some good indicator of a recession coming. So you guys are gonna be able to predict recessions. Sort of. Right? No, but seriously, this is what people look at.
Yeah.
This is what they're thinking about. And this is what you need to be thinking about. You're going to investment committee, and then what does everyone say? Here, this was this week, right? And he says, the questions to these brilliant experts, your picture could be here. He says, is there a bond bubble? Valuations are excessive, are really excessive, so this could be seen as a bubble. Negative rates are not unsustainable, are not sustainable in the long run. So that's what this is giving you. It's saying that's how we can look at this and figure out. So if you know that this is all happening, you look at your leading economic indicators, your spread between 3-month and 10-year treasuries, and it's all like showing you, are you like racing to go invest into real estate? Why? Why would you invest in real estate when you know a recession's coming?
Because you wait for after the recession for the prices to drop.
Right, exactly. So you think that there's going to be a devaluation of assets. And what would this say? This is maybe go look outside of the US. Right? This, if you were making a presentation to go invest into Vietnam, you might bring this out and say, so look what's happening here. I'm not so hyped up to go invest in the US right now, and this is why. Whereas then you go look at some of these numbers from Vietnam, And maybe it's different. So here we have economic indicators for China, right? So you can go follow the same thing. And again, when you're looking to go, do the underwriting for your different countries that you'll be assigned, you can look at some things like this. And this is the same thing. How's it 10 leading indicators? With recession is the same. And then look what happened in 2017. So here was the Great Recession, 2008, 2009, and now off the chart. Well, good. So let's see. Okay, so inflation. Do you like inflation?
The right amount.
That's a good answer. Okay, so what does it say? Real assets have provided a strong hedge against inflation for 2 reasons. Long-term returns have far outpaced the inflation rate. That's good, okay? And many commodities, foodstuffs, raw materials, components, CPI, commodity prices also tend to go up. So it's saying it's a good inflation hedge, essentially. Maybe yes, maybe no, in my mind. Depends on the real estate, depends what you're looking at. Also, it depends who your tenants are. If your tenants are incredibly inflation sensitive, that could be a real problem. You know, a lot of rents are tied to CPI. But does the value, and we just looked at, so there's income and there's appreciation. Does the appreciation outweigh the inflation that's coming? And are you buffered because of the rent? If your rents are really under par and your returns aren't really that great and you're depending upon inflation to get you the appreciation, that could be a risky game to play. Because you're not quite sure that you can get there. And you don't know that the real estate market is going to support that. But according to this, it seems like it's a good inflation hedge. But if you have like a 20-year lease on a triple net industrial building, and you don't have some inflation numbers built in, protection built in, so adjustments, that, you know, that could, like this, like who would ever thought that corporations would have these negative yields, bond yields? Same kind of thing. And we can look at, so this is global inflation. And if you look at it, it hasn't been, and there's some predictions here too, compared to prior, it's all around 3-ish%, not since 2014. Not crazy. But then we looked at the bond rates. US treasuries were what? Also around 3%, right? So you have to start to look at how that's all either impacting each other, or am I getting paid enough? If inflation is at 3% and my treasuries are at around 3%, and we said that there's only a distinction around 200 basis points between treasuries and real estate, and inflation's at 3%, I might be on the sidelines and say, wait, I need to get a little more return in the real estate side to make sure I'm compensating for the inflation, right? Public debt. Why do we care about public debt?
Chances of country default,
Right?
the default of the country.
Could be, right? But why is that affecting real estate?
The country itself,
Mm-hmm.
well, you can invokes like the whole economic activities in the country, and it's higher risk. Can
Right?
like
Right, so it's political kind of economic risk that we would take if we're thinking of investing in that particular country, absolutely. What else? Anything more specific to real estate?
Does it impact currency conversion?
It could, but that's a whole other conversation.
Maybe it impacts government spending,
Yes, exactly.
net
Right,
for GDP, I guess.
right, exactly.
I was also gonna say maybe the treasury bonds of the respective countries.
Right,
Isn't it
right,
impact
exactly.
taxes in the long run as well, which
Right.
could be hugely effective, whether it's personal taxes or corporate taxes or real estate taxes, all
Right,
of them.
and then the countries aren't putting money into what, infrastructure and things. So they have to increase the taxes, it's going to be a disincentive for getting tenants, which we love and want, right? And they're not going to be increasing the viability of this particular community to attract either developers and or tenants. So it's a really big imposition on real estate potentially. And it's something that we really need to focus on, especially when we're looking at building a global portfolio. What is the government debt for a lot of these countries? Like, look what happened in Greece, Italy, they're pretty much bankrupt. And nobody was, taking up leasing space and things. So, looking at this, look at all the higher debt, look at this. Is that scary or what?
There doesn't really seem to be a correlation though between the debt and well, in some places there is, but I think overall, because you have the U.S. and then you have countries like Italy and Spain, which obviously have very different real estate markets.
Right, so we can't just look at this, but it's something that is, I think, very important in terms of thinking about potential opportunity. But, there's been, everyone's talking about the trade war with China and the US. However, what people aren't talking about so much, which they should, is that the amount, I don't know what the number is, but the amount of treasuries owned by China is very significant. And if you were to anger them, like a lot, this is what's at risk. So if they all of a sudden started flooding the market, then they wouldn't do it because it would be self-defeating. But if they did start to just say, okay, we're out of here, and start to flood the market with.
Join hands with Russia.
Right, and put our debt out there, that could be very, 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 very damaging to us.
Do you think that's already a possibility though, because there's already IP issues in China, which is why a lot of corporations are now kind of taking a step back as to whether they wanna continue to build infrastructure there. And then in addition to that, China's starting to create they no longer wanna be a manufacturing country, they wanna start being an innovator in the market, in the global market.
Well, I think it's a combination of things, because you have countries like Vietnam who are lower cost manufacturers now. So you have other Southeast Asian countries specifically that are more financially attractive to a lot of the manufacturers. So there's just sort of a natural progression, and it's also part of the urbanization conversation, which is saying that the amount of, from farming to cities in China, that move has been quite significant. So you can't necessarily sustain all of that with manufacturing. But what's interesting is they could end up doing a lot of their own manufacturing and producing things more on their own. So I think there's still a huge opportunity in the manufacturing sector. I think it's just going to shift in China, compared to what it has been. Whereas manufacturing is for overseas companies, they'll create their own companies. and do it themselves, for themselves. And maybe, and they also were, outsourcing to Vietnam as well. So, I don't know if I answered your question, but.
Yeah, well, I was thinking the risk is still there regardless when it comes to China, right?
Yeah. Oh, in terms of the treasuries, yes, absolutely, yeah. There's nothing that stops them other than to be self-defeating. Because they own so much of it, so they would crash their own portfolio in many ways. But it might anger them enough, so who knows? But there is a risk. But you could say that it's built in somewhat already because of the low returns already. So, but this is a really important piece because it does impact how countries and municipalities spend money and who don't spend money. So here are different regions in terms of their GDP per region, and there's some forecasting here too. But you can start to see, look at the bands, and you can see, here. So the orange, I think this is the developing Asia Pacific. And you can start to see that that's where the expected growth is in terms of just GDP we're looking at now. And how I think North America is shrinking. Okay, well maybe this is North America. It's hard to see the different colors, they all seem very similar. Let's see, so it goes that way, Latin America, okay, so that's Latin America, that's sort of constant. Then sub-Saharan Africa is also constant, sort of, maybe a little bit growth. Developing Asia Pacific is where the growth really is expected. And then Middle East and North Africa is about the same. CEE. So then this is North America, and you can see it's a shrinking bar. And then Euro area is also shrinking, and Asia Pacific is sort of, and this is PwC, their analysis. So it's what you would expect, right? Growth in Asia, shrinking North America, shrinking Europe, and the rest of the world's sort of middle. Although people are talking a lot about Africa these days.
The real estate's high there though. It's not that low.
Right, because it's very expensive to manage
Yeah.
and I think access as well. So here you can start to look at also just the GDP growth rates in terms of correlation from one country to the next. Again, thinking about building out your portfolio and thinking which of the countries that would buffer, the others. So, Argentina compared to Australia or Eurozone is a good match. India to Japan, India to Indonesia. So you can start to really balance your portfolio that way. And then looking at public debt and the interest payments on the public debt as a percentage, and it's interesting because it's look at the Euro area and the public debt versus percent of GDP, right? So it's interesting that the interest payments on public debt for the US are about the same percentage of GDP as in the Euro area. Which I would have thought to be the case. And Japan is actually on the lower side. So it's like who can afford, so you could look at the public debt, but it's like how much can they afford? So as a whole number, it doesn't necessarily mean anything, but you need to look at it on a comparative basis to what it's doing. So, and then we can also look at the actual real estate compared to yields from treasuries. And again, this is 16, 17 year horizon, and looking at apartment yield is the red one and the 10-year treasury. So here you're looking at a spread of somewhere, it's much higher as you've gotten more, in the later years, which is good. And that's why you've seen a lot of institutional managers moving into the apartment sector, and one of the reasons is exactly this. That the spread is that you're really getting paid now. And why is that? Why do you think you're getting paid all this more now for residential than you have in the past? You guys have anything to do with the demographics? There's an apartment shortage. Right? So it all ties back, so that's why we're looking at the whole picture. The demographics is really important. There's a shortage of apartments, people will pay more for them. Or they just move home, back home with their parents, which happens too.
Also, the prices are really high, so people tend to rent.
Right, but why are the prices high? Exactly, why are the prices high? Right, so it's a supply-demand issue. So either the supply is too low, or the demand is too high, but they're related and the price goes up. And that's what I'm saying is happening here. This is being really forced by the demographics. That there in many cities, especially in the US, is this? Yeah, this is US. In the US, there are many cities that are, have apartment shortages. There aren't enough places for people to live. And look at the pricing. It's crazy, I don't know, it's tough. Oh, let's this, here, this one. So then you look at, well, okay, so if the rentals are too expensive, are people then going to be able to go afford to go buy private homes? You can start to look at that as an indicator of what's going on. So starts and permits. So a developer is going to do a start and permit thinking that someone's going to go buy the house, right? They don't want to get stuck with the house. So this is some indicator, not necessarily a correct one, but an assumption that, you know, there will be these purchases. And you start to see here too. So the housing shortage in rentals created the opportunity, what? To build new houses. But that brings up a lot of other questions in terms of, can they afford it? What are the interest rates, mortgages? So let's, you know, so we can start to look at mortgages or, okay, industrial, back to the industrial production, manufacturing. So these are all different types of things we can look at. Oh, this is good. Employment cost index. Looking at wages and salaries, total comp and benefits. So as an employer, they're looking at all these different pieces of the puzzle in terms of figuring out whether or not they can hire. Again, I'm not, you have to go through all this, but I'm just showing you what's out there, and that these are pieces of information that if you're walking into a market that is going to be doing a tremendous amount of hiring, you think, you're going to an opportunity zone. And you're thinking about, oh, great, it's tax benefit, blah, 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 but it's going to be also dependent on people hiring people. Well, take a look at, you need to understand the rent that you're going to charge is what percent, right, of these companies' income. And how are you going to get that? Wages are one of the largest expense items that any company can have. This is how you start to look at that. Okay, and then you want to look at, so we're looking at here, move this around a little bit, sorry. The mortgage, the housing production, well, what's happening with the debt? Because what, typically people put down what, 20%, 25% equity, the rest that they take out in loans? Okay, so here we look at what's happening with the different loan originations, commercial multifamily houses. So if you look at the recession, 2008, 9, 10, not many people were doing much of anything, and now it's picked up again, but still not to the same level that it was back in 2005, 6.
It's not far off though.
Right. Mm-hmm. And then here, I couldn't find an updated one. This was interesting to me, showing lending activity by asset type. Look at industrial. Quite amazing. That's percent change. And most of that was given from commercial banks, whereas now, I would tell you that is absolutely not the case. So that market's changed dramatically. Look at hotels in third quarter 2015. But you know, the hotels, that could be like 2 or 3 major hotels that could skew that whole thing. So, again, you just have to look behind the numbers.
Why would healthcare be negative? Like default?
It's a change, so they did 57% less lending in that sector.
Right.
There's also a whole wave of healthcare transactions just before this, so it's not necessarily that it was really bad, they might have just had like a couple record years and it's have a regression to the average
Right,
potentially.
right. It's just, cause this is just one quarter to another essentially. It's just a year prior, but that's it. Alright, so now it gets interesting. So CMBS issuance. Look what happened before the crash. So remember we said before, it's a matter of also how much of these things are, these guys are out there handing out the money. Look at that. So now, we are, let's see, so this was 2007 was around 230 billion. Look at 2018 and 2017. We're inching up. Right?
Last one.
Mm-hmm. Who's the blue? Up here, blue is conduits versus, color codes are on top. I don't know all the difference, it's all these different, I mean, I understand agency securitizations, which is most of it. But the point is, I don't care who's doing it, just too much of it. Which is scary. And then here are the actual who's doing it. And what's really interesting in my book is that essentially you have, let's see, 15, 30, 45, over half the market is done by around 4 or 5 of these guys. So they control the marketplace. And the rest are just, you know, hobbyists. So,
Pure pressure, entertaining.
really, it's like a leftover thing. So that's really important because, look at that. So you follow the CMBS delinquency alongside of, and it's starting to go up. And this is for 2000. I haven't looked at what it is recently. I'm too afraid to. But you can start to get the picture. So let's look at this. So here's December 13. Here's 2013 was about, say, 40 billion. Let's see here. And they issued 140 plus billion. So that's significant.
30%.
But that's of the new issuances, because these are probably the old issuances that, whatever, but I'm just to point out, that's really quite interesting.
And I'm sure a lot of that's like legacy delinquency from 2008, right? Like some of those deals were 10-year
Could very well
loans.
be, right. So here's, this is April 2009 delinquencies. Look at this. So this was 17 billion in 1 month. And we said it was 140 billion. Is that what it was? Yeah, 100, no.
No, it was.
No, it's 30, sorry, 40 billion. So it's 40 billion in 2013. So if you add the January, February, oh, that's just 4 months, so I don't know. I mean, I don't know.
And it kept going up after April 2009 too.
Right, I'm sure.
More and more.
But look at that. So if you were an investor and this was back in 2000 and, well, these are two. I'm trying to see if you could have looked at this. Well, this is what you would have to look at. We don't have the failures for these years. Like the question would be here, what were the defaults in like 2005 through 2007? But you can see that there was this huge jump in the issuances.
We talked about in capital markets class, and they were incredibly low because the prices were appreciating so rapidly. If any individual had trouble, you could just sell your way out of it because everyone looked smart from 2005 to 2007
It
because
didn't matter.
the appreciation was so quick, it just didn't matter.
Right, you didn't, it was all fake.
Well, everyone else really smart from those couple years, right? You buy something and it go up 30% in 6 months, but there's a reason it was way too high.
That's when the music stops. But the problem was that you had these people issuing this stuff that weren't valuing real estate properly. And just underwriting was just out the window.
And they didn't hold on to any of the debt, so they didn't care.
Right, they didn't care, exactly. Right, they didn't own it, they sold it. They were making money on the trade, not the debt.
Yeah.
So they didn't know how to underwrite and they didn't care. And these guys, right?
It's interesting in April, that's, Stoy Town deal would have been like a third of that thing. I think like over 4 billion of that was a CMBS and they went delinquent in 2009. So that one deal would have been like a third of that. Or a
Right,
quarter.
right.
Which is interesting.
And that was Tishman Speyer,
Yeah. And BlackRock, funny enough, held a lot of that debt.
Blackstone.
Or Blackstone rather.
Right, I know. And you had CalPERS in there.
Yep.
Lost their shirt. So, alright, so now, different types of real estate that are subject to this. Look at multifamily. And I guess the other one's retail. So again, and look at the shoot up in retail. So again, you can start to, segment where, push your boat in certain directions based on looking at a lot of this. Oh, so this I pulled out the other day. I like this. This is from economy.com, and it tells you what this is the delinquency rate. So it's 3.4%, which is not bad. Right? So this was, I don't think we have. Oh, here it is. So here. So this was up at 5.5%. Right? So we're 200 basis points below that. That's pretty decent. You would expect there has to be some level of, so 3.4 is pretty good. So I can speak to my investors and say, we're good to go. Oh, and look in here, they analyze it for you. The month's decline stems largely from the office property type. I do industrial. So, out of the 6 lines, 3 decreased, 2 increased, blah, 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 blah. And they also look at these parts of the country. So you can really segment this. And here's a housing market index, looking at housing market starts. Construction spending. So again, I'm just showing you what's out there. You have to whatever. Oh, I like this one, architectural billing. It says, tells you what's this for development. Housing starts again. Personal consumption, that's important. This is probably public, Green Street Commercial Property Index, National Index of all properties. Housing market again. Infrastructure, something you should be following too, in terms of where things are moving, in terms of development of ports and roads and all of that. That leads to opportunities in real estate. funky chart. It looks at university performance and whatever. Anyway, so now population, so you get the drift. There's a ton of different indices out there. You can measure everything under the sun and then some, but it's your choice to pick what really is relevant and how you use that to guide you in a portfolio investment decision. And we touched upon the fact that demographics are relevant in the multifamily housing sector specifically, but in lots of other things too. And look what's happening to the aging population. By 2050, almost a quarter of the population is going to be 60 years old or older. Why do we care about that?
Type of housing stock, maybe that you wanna
Housing
look
stock?
at.
Right, but why? What is it? What happens? So like Japan's off the chart now.
Hopefully lesser on the rental side and more on the condo side.
Well, what happens? People start to retire. Go ahead.
They're probably not gonna be looking for new housing.
Right. Right.
Theoretically, longer term down the road, they might be looking at more like seniors or retirements types of
Right. So there's a
housing.
big push now for retirement home development, right?
I guess also there's productivity of a nation in general. If you don't have the young people who put in the work, the output will go down in
It goes back to
on the
GDP.
aggregate. Yeah.
Right. So right now in Japan, I forgot the exact numbers, I think it's amongst 50-50, where 50% of the population isn't working. They retired. So 50% of the population has to support 100% of the population. That's scary. What does that say for GDP growth, for any kind of growth? Who's doing what? So that's huge impact on real estate. Who's gonna be in the offices? Do you need offices? Right? Where are you going to this whole thing with immigration, it's somewhat ironic because you need people to manufacture things, to do certain things, and a lot of that's dependent upon immigration. And you close the doors to that, and then all of a sudden you don't have labor pools to be able to do what you need to get done. And that will then impact ultimately your GDP growth and everything else around that. So you see how it's all one knot. So right now, we're probably somewhere around, I don't know what the exact number is, but 12-ish% or so for that. But also the pension reforms. So guess what? Who funded all this real estate?
Pension fund.
Right. And now all of a sudden they have to pay out the liabilities because the people are retiring. So remember I explained to you how the actuarials come in and calculate what kind of returns each pension fund needs per year to meet their liabilities going forward, right? We call it the actuarial return. So if you look at CalPERS on their website, you should probably find, if you type in actuarial return, then it's probably 7.5%. But if you have more and more people retiring and they have to pay more out, they have to have a higher return to meet those liabilities to pay the pensioners, the policemen, the firemen, the teachers, everybody who's retiring. So what's going to happen? They're going to be forced into making riskier decisions to get to the higher returns. So it sounds hokey and stuff, like who really, it's critical. Because ultimately it could also flood more capital into something like real estate because of the returns, because of the great asset liability match. So with that, now all of a sudden you're impacting what? Returns and valuations. You have so much money flooding into real estate because people are retiring and the institutional capital market, which is most of the marketplace for real estate, is desperate for returns, and your money flooding in there and they're all competing for the same real estate. So look at this. So look at Japan. Top line. Right? Old age dependency ratio. So Population as percent of the population. Look at that. You're looking at that, it's gonna be 70%.
Wow.
It's insane. Right, so even look at 2020, so I was right, it's 50%. What's the second line? Brazil, is that Brazil? No. EU maybe. I can't tell.
Yeah.
Yes.
EU? Yeah, maybe it's EU. Even EU, so in 2030 is 40%. And the dotted lines, Mexico, Russia, Turkey, where's US? Is this, this line here. I think, right?
They wanted to make these really hard to read.
I know, sorry. But so the US looks to me like in 2020-ish, we're reaching 30%. That's baby boomers. So that's significant. Now this was done back in 2010, so I don't have the up-to-date one, but here. So today, according to this, 12% is by 2050. Is it time? Oh, no, I'm just doing, you're, okay.
Maybe it is.
Yeah, it's a,
It is?
No, yeah, it is. It is, I don't know, I don't have a.
Yeah, it's 10-2.
It is? Oh, okay. Alright, so let's stop with. Okay, you get the drift, you see what's going. Wow, we did almost everything. Alright, we'll start next week on global cities, which is really interesting. So, okay. You see how it all impacts each other now, and how important it is?
Yeah.
When you start to understand where the money comes from for the real estate especially, you start to like get like, oh my goodness, like, okay, I really need to understand that because that's going to impact valuations and returns and where things are going.